All right, that is the time. Let's go back to the main camera. And we are live. Thank you guys for tuning in. Let me turn that notification off. Appreciate you guys tuning in for another edition of the weekly live stream. We're off to an awesome start in 2023 so far. The plans that we've set out have been executed very, very nicely, and not a lot to complain about. So we're going to recap those quickly and then talk about the all important game plan for the upcoming week. A little bit of housekeeping for those of you that are in the Discord server. Something we've been trying to keep to a minimum, but is kind of impossible to stop, is the fact that we've had some people joining who are trying to impersonate me. As a reminder, if you are in the Discord server, I am never going to ask you for personal information. I don't need your personal information. I don't need you to sign up for something. If there's someone asking you to do something like that or asking for info, money, etc., that's not me. Please do not fall for that. But with that said, let's go back to the normal presentation. Put myself back in the corner. And we are ready to go. Toboggan, appreciate the follow. Let's get it going. Last week we took home a profit of $3,681, which, in and of itself is fantastic, right? We took home a 2.08% return. We typically like to aim for 1% or better per week, so we've accomplished our goal. Now, it is a little bit bittersweet in the sense that we underperformed both the S&P 500 and the NASDAQ. And why is that, right? Why did that happen? Why didn't we make as much money as them? Bigger picture, the strategy, it's going to be tougher when the market really, really explodes to keep up with it. We make our money and we outperform. Get it, right? We go to this tab. We outperform. We're doing it. But we outperform when the market drops back down and we can afford to take that little bit of a dip. Now, the market did not have a dip at all. And in fact, we had a very, very volatile CPI event this past week. And proud to say that we were zero. I think we had zero positions heading into that, which is fantastic, right? Means that we had zero risk. So while it did kind of go bullishly, where the market moved up after that, the big thing that we could rest assured about was that if the market had completely collapsed, as we've seen several times in the past after CPI data came out, we would have been just fine and we would have outperformed massively. But look, the way that I view the market this year, we've seen several different weeks in the past where we played those more volatile events and we dug ourselves a little bit of a hole that took a few weeks to get out of. We know that we can handle a normal red week in the market. Sometimes those red weeks driven by volatile events are a little bit tougher to get out of. But so long as we avoid that kind of a risk and just kind of keep building on the prior weeks, I think we just focus on running our own race for a little bit here. Bigger picture, through 2 weeks, we're plus 3.59%. That's fantastic. That's on pace for a very, very large amount of money overall on the year. Are we going to keep that up for the entirety of the year? Very likely no. Very likely no. Expectation management is very important. However, when we look at NASDAQ and the S&P 500, they're up 5.85 and 4.20% respectively. We'll remember that the average return in the S&P 500 is between 9 and 10% per year. This is already half of that. So what I can guarantee you, and not a lot of guarantees in the market, but I can guarantee you that the S&P 500 is not going to keep up this pace. So even though we're slightly behind them so far after a couple weeks, as you could see right here, that's okay. These are the times in the market where we focus on running our own race because it's very, very easy to get complacent, see a few green weeks in a row and say, you know what, I'm just putting more money in because that would have made me more money in the past, yada, yada, yada. And that's how you get yourself knocked back down. We love RSI as a technical indicator. And we're leaning on that a lot for the upcoming week. We're a little bit of a spoiler. We're largely bearish in our portfolio. And if we pull the Thinkorswim module back over here, we'll see that futures are slightly red. I mean, nothing crazy. That's definitely a number that could be gone within the hour. But so far, so good from that regard. We'll see how the actual individual stocks shake out. But going down the list, we really didn't make a lot of mistakes last week. You see some red right here, but that's because this is a covered call and we made a bunch of money on the shares. So overall, we made $1,000 on DraftKings. We lost $43 on win right here, but that's a continuation of a position, right, where we already locked in a $32 gain. So we literally lost $11 on win last week. And we were able to roll these up and out, right? Because this was a 98 strike call. We rolled it up and out to 99, making that break-even price even higher for a bearish position. And we're on track as it currently stands to make 78. So that's a position that's going to be profitable if Win just stays completely flat. TQQQ between those covered calls and the shares, we took home about 1,200 bucks. ChargePoint made money, Unity made money, XSP, the first strangle we ran, lost money. But if you look bigger picture, we opened up another one, and if we go to our XSP strangle tab, definitely something to keep an eye on, because this is maybe a newer strategy that we're starting to deploy and starting to track, but so far so good in that regard, right? We did lose 384, and I think the one mistake we made up front was we did what we're supposed to, right? We had this 384, 391 for 333 credit, meaning that our break even on the high side was 394.33. When that gets breached, we want to add another call to further raise that. But in order to hedge that out a little bit so that if the market keeps sprinting up, we get something, we should have opened another put. We only opened this call. This lost us 121 bucks. We could have similarly opened something for about $1 on the lower side and made that 100 bucks back, so that our initial loss on that first straddle would have only been about 284-ish, but it is what it is. Whoops. We'll keep an eye on that and try to do a little bit better going forward, but we'll remember that we had these expiring on Wednesday because we wanted to avoid CPI, very volatile event. It's one of our rules down here in bold. And then after CPI was over, we opened up another strangle for Friday, and we got out of that one for 16 cents, so we made 219 back. So while the initial strangle probably could have been managed a little bit better and did result in a little bit of a loss, the second one that we opened up after that made us a bit of that back. So all in all, in the week, we lost 165 bucks on XSP, which is kind of nothing, right? Because the first three of these, we made 556, 340, 179, right? On average, that's 358 per strangle. And if you take a look at what we've got set up next week, we've got another strangle, which is going to potentially make us $349 at max profit on a short week, right? Because the market was closed today for a holiday. So we've got 4 days to keep it within this range and potentially make 349 and continue to just build on these returns that we've seen from these XSP strangles, right? Average return of 2.28%. And that's using $8,000 of collateral. Well, remember that we looked at these using MES. We're using XSP, but you can use MES where collateral is only like 2,000. And then those returns start to look very, very interesting, to the point where even with that loss last week, we would have been at a profit of about 45% on these trades so far. But anytime you're starting out a new strategy, you want to be a little bit more conservative. Just because we've got these really nice returns doesn't mean, oh, let's 5x these position sizes, because things can go wrong, things will go wrong. Let's just keep things a manageable size. I could definitely see myself going up to like a 2 size, maybe doubling it in the near future. But I think I definitely want another month or so of experience with these just to make sure that we've kind of got the whole process under control. But so far, so good in that regard, even though we lost money, right? We say all the time, just because we lost money doesn't mean it was a stupid trade, and I think this was a great example of that. Where's the rest of the stuff this week? I mean, Affirm, we made money on the short calls we sold, the short calls on Spotify, WBD, Peloton. I mean, there really, other than XSP and Win, where we lost 11 bucks, there really wasn't a losing trade this past week, which was fantastic, and that's why we netted down to all this cash. You might say, oh, well, we didn't lose. How did you underperform the market? And again, that answer is because we just did not hold that much, right? We had very, very little risk, because if the market fell back down, we would have been just fine. So that's what happened last week, and I think maybe one more point I want to make is about using RSI to enter into some of these bearish trades, because that's going to lead into the discussion about what we have set up for next week. So looking at something like, let's look at what's another one of the bearish trades we entered a little bit further up. TJX, PDD, and Win. I think these are all fantastic examples. And every single one of these, when we look at the chart, we're going to want to remember that the market ran a ton last week. The market ran a bunch. So let's look at TJX first. Over the last 5 days, when the market ran a ton, what did this thing do? It finished lower than where it started the week. Obviously, that's unusual for TJ Maxx. Or excuse me, that's unusual for a stock in a market where things are really, really moving upwards quickly. And why do we think that is? The answer is that RSI that we love to take a look at, right? If we take a look at the 1 year, RSI got into the red here for a short bit of time, and when we saw it get into the red, it coincided with a little bit of a pullback. And again, we love to open these calls because even if we're wrong and it keeps going up a little bit, we get a little bit of a cushion. So that's that. And that worked really, really nicely for us. And we took home a profit of, where's TJX? We took home a profit of $76, which isn't a ton, right? But between these three examples, it's a profit of 101. Again, nothing to really write home about. But if you look at some of these other short calls we opened, like Affirm, Spotify, WBD, Peloton, then we're into 410. And I have a delivery that I have to go grab really quickly. So, have not done this before, but 5 minute intermission here. I'm going to put the timer back on. Apologies for having to run out, but we'll get back and we'll jump right into what we're doing next week. Let me restart this. Okay, I will be right back. All right, a minute 15 ahead of schedule. We are back. Had a food delivery that I thought would get here before the stream, but got a little bit delayed. But that'll be waiting for me when we get done. But finishing the point here, let's talk a little bit more about some of these other bearish trades, right? Because some of these are being pushed forward into the following week, so I think it's important to understand the trend there, right? We finished taking a look with TJX. Let's take a look at PDD, right? We see not only do we have an increase in RSI where it gets into the red over here, but we also have this. This is a 1 year, so we don't see it. But if we go back to the 3 year, we're going to see that we have a level of resistance identified. So if you have two things working for you, where you have both a really, really high RSI, which is bearish, and you're approaching a level of resistance, that's also going to be bearish, right? So we've got two things working towards us to kind of build this bearish thesis here. And as it approached that, you'll notice that we drew the line before it got there, because I think we talked about this a little bit last week, but it ran up there and then immediately kind of got pushed back down and went from 99.3 at the peak down to 91.27 down here at the trough. Now it did run back up, which is like, I can't stress enough the importance of closing some of these a little bit early, especially if you've got a stock that's admittedly a little bit more in a dangerous or volatile bucket like a PDD. Some of those Chinese stocks really have a tendency to kind of shoot up or shoot down. So when you see some downward action like this and you have a bearish trade, close it, take the profit. You're not going to regret leaving 20 bucks on the table early in the week because, you know, big green candles like this can and will happen. Now, this still would have hit max profit, which is why we love these trades so much because they have that big of a cushion. But just something to keep in mind, taking profit, you are never going to go broke taking a profit. But again, larger picture right here, right? We identified some of these stocks that have really, really high RSI numbers. And despite the fact that the market was flying upwards, right? And we saw that the market was up 2.69 and 4.82% on SPY and NASDAQ respectively. These, on a 5-day basis, finished lower than where they started. And I personally think that's fully attributable to it just being overbought, a little bit exhausted, and just needing to fall back down a little bit. Let's go back over here. What was the third one? It was Wynn. Let's talk a little bit about Wynn. Same idea. However, this one kind of broke through this level. So this, I think, is maybe a little bit more useful discussion of, okay, we have this bearish thesis because it's not going to, like, this isn't going to work 100% of the time. And if it did work 100% of the time, I would be very rich because I would be leveraging my money as far as I could and playing these back down every single time. But again, they're not going to work every single time. So let's talk about how we want to manage a trade like this when it does continue up through this. We had some things that we really liked, right? On a 1-year basis, we had RSI that was, you know, mid 70s, which is very, very overbought. When we were also approaching a previous level of resistance at about 97-ish. So we thought that it might fall back down off of that. But if we take a look at the 5-day chart, yes, it did initially work. That thesis worked for a day. But then on Thursday, we saw a pretty big green candle that took it up through that level, and it continued upwards. So, big question when a trade like this moves against us. Obviously, you're not going to be able to sit back, take profit, let it expire, etc. How do we manage this? What do we want to do? So we take a look at our initial position, and it was a Wynn 97 strike call. Now, we actually took profit on this one a little bit early. We closed it Wednesday afternoon because we didn't want to be involved with any trades heading into Thursday morning. So by here, we were already out of the trade. Now, Thursday morning comes, we see the big spike up past 97. So what we were able to do is jump in on the same position, right? Because look, big picture on a 1-year basis, that RSI is still overbought. We're bearish on this because of that, so we're going to continue to be bearish on it, right? And if we're bearish on a stock at 95 and we're happy to play it down from there, if it runs to 100, theoretically, we should be even happier to play it down from there because it seems like it would be even more overbought. So if we pop back here, we roll the strike up one. We sell it for 85 cents, which moves our break-even price to 98.85. And then if you want to add the 32 cents in there, technically the break-even price was 99-ish. And then that ran past that. So we had to close for a 128 debit. And here's the thing, right? If you look on a more short-term basis, this thing really kind of ran up against us. But even though it ran pretty significantly, like 7-ish% from the bottom, we still only lost $11 on it last week. So while these can be a little bit risky just because of the fact that they are naked calls, if you size these appropriately and manage properly, it really isn't that risky. And what do I mean by size appropriately, manage properly, pick appropriate stocks? If you look at like a 3-year chart on Wynn, yes, there is a huge drop-off. That's the COVID drop-off. That's going to happen. But what you don't see is any massive, massive green candles that would really like crush you, right? And what I compare this to is something like, you know, a Bed Bath & Beyond, where if you look here, you've got these massive, massive spikes and wicks on these candles. If you look at something like an AMC, you've got these huge squeezes. Something like a GameStop, it flies up. These aren't the charts we want. These are the charts we want. As long as the movement is a little more gradual, One other thing we want to check is that it's not liable for a short squeeze, right? What's the best way to check that? Technically, short interest data is a little bit delayed. So what I like to do is I go to the trade tab and I look for an HTB indicator. If there's an HTB indicator, that means it's hard to borrow. And if you look at something like an AMC, there's the big red HTB. It's hard to borrow. Why is it hard to borrow? Because a lot of people are borrowing shares to short it. So that's high short interest creating a hard to borrow situation, meaning we should avoid this setup. And we wanted to play something like ChargePoint, right? ChargePoint, CHPT. While the 1 year RSI wasn't quite where we wanted from a bearish perspective, it was getting close to there and it was on our radar. So we had some initial thoughts about potentially playing that back down for the coming week. However, we go to the trade tab, HTB, just do not touch it. Setting rules like this for yourself when shorting things by selling calls is very, very important because one bad naked call can ruin your entire portfolio. So we want to do everything that we can to make sure that the stocks we're selling these on aren't liable for that type of a move. But I digress. Back to Win, you don't see the HTB. We're comfortable that movement on a longer term basis is a little more gradual. Yes, it did move against us, but at the same time, it's even higher than it was before. So in theory, if we're happy with playing it back down at 95, we should be even happier playing it back down from $100.25. And that's exactly what we did, right? So you go down here, we closed for a 128 debit, and then we rolled up. I think we rolled up, right? We went from a 98 strike call, and we rolled that up to a 99 strike call. And we got a 203 credit. So with cash secured puts, we always like to roll down and out for a credit. What does that mean? Roll the strike down, roll it out, rolling it out a week, and then roll it for a credit, meaning that you sell the new one for more than you closed the old one for. With these short calls like this, which create bearish positions, we want the opposite, right? We want to roll up and out for a credit. So we rolled up going from 98 to 99, which already raises your break-even price by $1 right there. And then we want to roll that for a credit. And then that credit is an additional increase to your break-even price. So you'll see that even though we started with Win at like 95-ish and we made 32 on the first, lost $43 on the second, and even though Win has run up this much on a 5-day basis against us, we're in a position here where if Win stays flat at 125, we're making $67. And if it falls all the way back down below 99, which is not that big of a fall back down, right? It's a pretty short retracement to get back down on the other side of 100 for us. And again, last time we saw RSI get this high, what happened? It might not have happened immediately, but over the next 2 or 3 weeks, it falls right back down. And that's why we're such big fans of RSI as a technical indicator and use it to line up our entries into these bearish trades. So if it falls back down below 99, we've made $203 on it next week. Combine that with these two, and that's $192 of profit overall on Win. A bearish trade which will make money even though the market has run up like this. And that's why we're such big fans of RSI and setting things up like that. And I probably sound like a little bit of a broken record talking about RSI this much. But let's get into next week. Let's talk about what we've got lined up next week. Week 1 and week 2 were very, very successful. We bagged a profit of $2,500, $3,600 to put us to $6,200 of cumulative profit in 2023 so far. We are slightly underperforming the S&P 500 through 2 weeks, but that's okay. We got to run our own race like this because, again, bigger picture, we talked about this at the top of the stream. S&P 500 is up 4.2%. NASDAQ is up 5.85% so far on the year. That's not going to continue. That rate of increase is not going to continue. What we can control is protecting ourselves because, look, if SPY goes down and NASDAQ go down, they're going to go down, right? They kind of largely move together. They respect RSI as well. They have dips. They have rallies. That's just how the market works. What we can do is position ourselves in such a way where if the market goes back down, we don't have to take that dip with the S&P 500 and NASDAQ. So how do we do that? And I think the most effective and best way to do this is to balance out bullish and bearish trades for the coming week. Now, typically we go into weeks with largely bullish positions because we're of the opinion that the closest thing to a guarantee in the stock market is that it's going to go up in the long run. So having some bullish deltas in your portfolio is going to be the best way to approach a random week. But with that said, we love to talk about RSI. Let's talk about where it's getting on the S&P 500. We go to the charts, we type in SPY. On a 1 year basis, it is at 60.25. We've got this line right here drawing out the downtrend. If we zoom in a little bit on a 180-day basis, it's fallen back down a hair. And I think that's because we've got some after hours movement being factored in right here. The futures are down about 0.34%, which is, there you go, 0.35. Keep it going. Decent start for us because we are largely bearish coming into this week. Zoom in a little bit further and we're going to see that this downtrend that we drew, where's the downtrend that we drew? Oh, it looks way flatter. I thought that was just some random flat line. But it comes in at about 404-ish, 403-ish. So maybe another 1% of upside I could definitely see, but when you've got all these different factors coming together, right? You've got 1-year RSI running pretty hot. You've got it running into this downtrend line. I imagine we'll at least see a short-term bounce back off of that. And again, that line was at about 403, so we could see another 1% of upside. Who knows? I'm not here to guess market movement on a day-to-day basis. We like to look at some longer-term trends because I think largely in a given day or even a given week sometimes market movement can be entirely random, right? You could have all these technical factors lining up that say something might be bearish, then all of a sudden super good bullish news comes out and all of that. You could just crumple it up and throw it away because it won't matter. But if we, let's see here, take a look at what we've got for the coming week. We've got $2,500 in base profit, which is going to be another 1.5%-ish for us, so we can continue building on these gains so far in 2023. Now, here is the important discussion we're going to have here, and it's what are we holding for the coming week? How are we going to realize this profit, and why is this going to help us if the market goes down? The answer here, if we go out to the right and look at our break-even tracker, is that a large majority of our trades are bearish trades, and the way to read this is anytime we have a bearish indicator, obviously the trade is bearish, and this percent right here is the cushion we have on the upside, right? So WBD could go up 1.9%, we'll still make money on that bearish position. DraftKings could go up 3.5%, Wayfair can go up 7.5%, Spotify 3.5%. We've got decent cushions on these. Again, just in case we're wrong, because we saw on that SPY chart, we see that there could conceivably be another 1% or so of profit to the upside on the S&P 500. So we want to give ourselves a little bit of a cushion off the bat before really starting to scale more heavily into bearish positions. But that's the idea going forward here. But we are largely bearish. So if the market does pull back, we're going to have a profitable week. And this is where I really want our outperformance to come from, right? It's really hard with what we do to keep up with like a 5% week, right? Because that'd be a massive week. We're not going to try to do that because look, that just doesn't happen very often in the market, so that's not something that we're going to try to play most weeks. With that said, if this falls down like 2 or 3% next week, which would be a decent dip back down, but again, it really would kind of only get you flat on a 2-week basis. So while 2 or 3% might seem like, oh, that's a pretty big dip on a 4-day week, that really kind of gets you flattish on a 2-week basis. So let's keep in mind the magnitude of some of the moves that we're seeing. But if that does happen, kind of circuitously getting to the point here, we're going to make some money, and that's going to be some massive, massive outperformance for us. So taking it from the top, WBD, what are we looking at right there? Let's pull up the WBD chart, and I think this is one of the favorite charts that we have a bearish position on at this point that I would love to talk about. So we go to a 1-year chart, right? This is kind of our baseline RSI view. And RSI is 74.26. You'll see right here when I move my mouse, 74.26. That is very overbought. It has not been that high in the past year. We can go to the 3-year where RSI may be a little bit lower. There you get down to 51. This has had some crazy moves, not so much to the upside, but that massive red candle to the downside. But over the past year or so, much more muted moves. And there's some really, really nice premiums on these that help us manage that break-even price. So what is the trade that we are currently in? We go to the 5-day chart. We see that this thing's run up from like, 11 to 13. Again, RSI is running hot. We expect it to at least momentarily come back down. This is essentially a 4-day trade, so momentarily is all that we need to win the trade. If we go look at the history of the trades, we actually started this one last week with a 13-strike call for 12 cents. So what do we like to do? We typically like to roll up and out for a credit, but sometimes when it's sitting right on that strike, rolling out same credit for a large credit isn't the worst move in the world too, especially when RSI is running as hot as it is on that one on a 1-year basis, right? So our normal break-even price on this, again, this is bearish, so we want the stock to be below this, is that 13 strike plus the 12 cents of premium, meaning a 13.12 break-even price. We closed out for 9 cents, meaning, the debit to close is 9. The credit on the new position is 39, so we rolled for a 30-cent credit. So what that does is take our 13.12 break-even price and add that 30-cent credit onto it. So our break-even price for this week is going to be or not for this week, but for the overall trade that is going to be 13.42. So if we draw that on here, we're going to see 13.42. Now, why do I like this idea as opposed to rolling up and out for a credit? Because we could have done that, right? Remember, we closed the last one for 9 cents, so what we could have done for the following week was roll up and out to like a 13.5 for a 21-cent credit, which would have netted out to 12 cents, and would have taken our break-even price up to like 13.70-ish, right? We would have been up here. That's a safer trade, and I don't think there's anything wrong with that trade, but when we see things just continue to move up, combined with a market that looked a little bit overbought, I think taking the more aggressive trade is the move, right? Because we see that we would have gotten about 21 cents of premium on that 13.5. And what we'll see right here is that we had 39. So if it does fall back down below 13, which is very, very conceivable, right, on a 10-day chart, all we need is for it to come back down below here. Not a lot. But we'll take home a max profit of 390 bucks on this one. So, that's more of a position that coincides with the idea that if the market pulls back, we're going to make a little bit more than this 250 we're showing right here, right? It'll pop up to that 390 number, and that's a great start for the week, right? Remember, with our approach in our portfolio, we're never trying to hit home runs. We want nice, small base hits built up by smart, consistent, and profitable trades with decent theses, and have all of those cumulatively come together to give us a nice week. DraftKings, this is one we managed a little bit differently than what we have before. If you take a look at DraftKings, we're profitable in the overall position. These shares weren't gotten rid of at 14.11, unfortunately. They're like 11.5. So effectively, or they were like 12-ish, sorry. So we've made about $1,000 on our DraftKings position. And when it runs up like that, you kind of just leave it. If we take a look at DraftKings on a one-year basis, although I think the 180 chart is probably going to illustrate this a little better, right? This is not the first time that we've seen a big run up like this, right? It's bounced off of 11. We had some confidence that it may have done that. We unfortunately were only able to ride it up to about 12, which, look, it's okay because we start taking shares on the way down here. And anything above 12, we would have made that profit, so we're perfectly happy. And bigger picture, for those of you who haven't been following us for very long, DraftKings is one we started playing on November of 2021. So it's been like 14 months of us playing this one, and we started this at 36. So if you take a look at the 3-year chart, we started playing it right around here. And you'll say, wow, that is a pretty big dip, because it is from this point. But what if I told you that thanks to the premium that we've been selling on this one and the way that we've managed it, despite the fact that DraftKings has decreased 60.81% in the time that we've been trading it, we took home a profit of $1,000. You might say that's a lot of work for $1,000 over a 14-month period, and I think you'd be right. But bigger picture here is the fact that we've got this strategy that can handle these types of dips in case they do happen in the market. But what we do want to do is not get too greedy, right? When we do get that bounce that we wanted, and we got that bounce absolutely, we don't want to chase it, right? We go back to that 180-day chart. RSI is pretty red. What happened the last time RSI got this high? What happened the last time RSI got this high was when it ran up to 17, and within a few days, it was back down to 11. Now, granted, this big red candle is from earnings, but before that, it would drop from 17 down to 1566. Now, we started playing DraftKings at 36, so we love the idea of continuing to play DraftKings in the low teens. We just don't want to get too greedy, though. So what is a good way for us to get shares back? We think it's going to come down in the short term, but we want to get some shares back. So what do we do? And I think the answer, when you have that combination of being bullish on a stock, maybe more long term, but being bearish on it short term, I think a strangle is a fantastic way to play it. So why is that? The answer is we have this bearish trade right here, the 14 strike calls. And if DraftKings finishes below 14 next week, those are going to bag us $400 on their own. Now, normally if we had only played this bearish position, our break-even price would be $14.40, which if we go to the 5-day chart, $14.40, I'm going to have to remove all these old ones. $14.40 is here-ish. So we'll see that. And that's decently above where it traded last week. I think that in and of itself is a decent cushion. But if we add this bullish piece, right, the 13.5 strike puts, Our break-even price on the high side goes from 14.4 to 14.61. So now we're now up here, 14.61 break-even wise. So we've taken the initial bearish break-even and we've increased it further by adding that bullish position, which is going to derive some more premiums if it does continue to run up. Naismith in the YouTube chat. What's going on, man? Welcome. But again, we know that while we're bearish on DraftKings short term, we are really open to the idea of taking on more shares. But since we got rid of our shares last week at around 12-ish on a net basis, like 1175-ish, 1180-ish, we don't want to immediately rebuy these shares for like 13.5. So what we do is we start with these 13.5 strike puts, again, the other side of that strangle, which in and of themselves, let me pull the calculator up here so we can make this math as obvious as possible. We have these 13.5 strike puts. We subtracted 21 cents of credit. Normally we'd be getting those shares at 13.29, but even 13.29 is still a little bit elevated compared to where it's been on a 5-day basis. So what do? We also sell that call as part of the strangle. So our basis isn't going to be 13.29, but 13.29 minus that 40 cents that we received from the 14 strike call, meaning if we were to take shares back on, we're going to get them at 12.89, which is all the way down here. So I think that's a much more respectable area to take DraftKings shares on. But on a weekly basis for what we've got going next week, we've got a nice profit range. We think it's going to be coming back down because that's kind of what DraftKings does sometimes. But we want to reacquire the shares, and we have ourselves set up to reacquire them down around at this level. And if we go back to the 180-day, 12.89 is a perfectly fine place to re-enter into these shares. And then you also want to have position sizing in mind when you're setting up something like this, right? We know that 10 contracts is half of a full-size position for us. So we'd get half of a full-size position at 12.89. And if it continued to drop from there, we could then deploy the other contracts to potentially grab the other allotment of shares for under 12-ish bucks a piece. So that's what we're working with right there. That's that DraftKings position. At max profit, if it does finish somehow between 13.5 and 14, we're going to take home 610 bucks on it. But I think more realistically, we probably get breached on the low side and then get those shares that we were looking for. With Wayfair W, it was running pretty hot the past week. As you could see on a 180-day basis, it got a little bit red towards the back end of last week. Let's zoom in a little bit. We saw it fly up here. Longer term trend, we go to the 1 year. We noticed that ever since about September 16th, this thing's been bouncing between a range of about, this line's at 46.75, this bottom line's at 28.02. It's starting to approach that 46.75 top line again. The market's getting overbought, so what do we have here, right? We've got a few things working for us. We have an overbought market. We have a stock that's starting to get overbought, and the third thing is we have the stock starting to run into a point of resistance. So that's three things working for us for a bullish thesis. Now, Wayfair, we talk a little bit about staying away from stocks that have the tendency to run a bunch, like AMC, like a GameStop, like a Bed Bath & Beyond. We go to the trade tab. It's not hard to borrow, so I don't think we're terribly at risk of a short squeeze. But if you look a little bit longer term, you know, there's some larger candles. Nothing too crazy on a shorter term basis, but I would hate to get back in the way of something crazy happening to this one. So what do? We still want to play it down because I think that bullish or the bearish thesis still exists and is a very good one at this level, right? Because there's even another point of resistance, maybe around 43.50, kind of where it's currently trading, that I think we could potentially benefit from. So what do? Instead of just selling naked calls, we sell a call credit spread because it's going to be a little bit safer, right? Just in case it does decide to shoot up, that 48 strike call that we're buying on the back end of it is going to make some money, give us a defined risk trade. But all in all, we end up with the trade where max profit is 235 anywhere below 46. And if it goes above 48, max loss is 765, which would suck to take that. But the only way you take that is one, if it goes above 48, and two, if you hold on to it until expiry. If it shoots above 48, I maybe would have ideas of just closing out the 48 and letting the 46 ride, which would take it naked. But if the 48 gets breached, RSI is going to be scalding hot. So that'll be a bridge we cross when we get there. But for now, very protected, defined risk play, 235 max profit in exchange theoretically for a 765 max loss. But of course, we could very easily get out for less than that max loss. When we talked about this one, we're rolling this one from last week, just continuing to move that break-even price up and up and up. We started with 97 calls last week, and going into this week, we now have a break-even price where we'll make money anywhere basically under $100.50-ish. So decent progress. And if it runs up past that again, we could do a couple things. We could roll up and out for a credit, or two, we can just add another contract, right? Anytime we get into a trade like this, we always want to have the ability to double down into that trade. And we have that here. We're very comfortable with adding a second contract on Win. Spotify. This is one that was on our radar. We did take it out last week, right? That 92 strike call that we sold made us $105. But the great part about selling calls like this is you don't need to get that huge dip back down to make the money. If we take a look at the Spotify chart, what you're going to see is that we didn't really even get a dip back down. It kind of just traded flattish over a 3-day period. But again, that's the great part. Flat is good enough for us. Flat at that 92 strike was good enough to close out for a 10-cent debit and lock in $105 profit. And flat was also good enough to keep this setup alive into next week. So we sold a 94 strike call for $1.20, meaning we'll make another $120. So last week the situation was if it stayed below 92, we'd make 115. But if we take that 105 that we profited last week and have already locked in, combine that with the 120 that we have potentially lined up here, we are now in a situation where we'll cumulatively on a 2-week basis take home $225 on Spotify if it now stays below 94. Which is right here. And of course, on an individual trade basis, that 94 strike call that we sold for $1.20 has a 95.20 break-even price. Zoom in on a 5-day, and that's going to be all the way up here. So I think that's a very, very nice place to be at. And again, we've got some of these other technical factors working in our favor. On a 1-year, RSI sitting at 71.67. We're approaching previous support, which will turn into resistance, right? If you look back in April of 22, we've got a bounce at this 93.50-ish level. We've got another bounce here at the beginning of July, end of June 2022. It breaks down below it, but when support is broken, what does it turn into? It turns into resistance again, and we saw that evidenced by the bounce off of it at the back end of October in 2022 when it fell back down off that level. And again, this line is drawn at 93.68. The call we sold is at 94. Clear of that, our break even's even higher. Really love the bearish setup on Spotify for the coming week. XSP, let's talk about that a little bit more. We talked about that a bit on the front end when we talked about how those went for us last week. But if you go to the XSP strangle breakout we've got here, well, we're crushing it on the XSP strangles. We've been doing these things for about a month at this point. And even though we did have one loser last week, we've still taken home $910 of profit. Good enough for an 11.38% return on our $8,000 of collateral. And for those of you who are watching this like, I don't have $8,000 of collateral to do this on XSP, you can also use MES, where collateral is only $2,000 to run this. And then all of a sudden, your return looks like a 45.5% return on capital, which is fantastic. But again, expectation management is important here. We never like to use hyperbole in our returns. We like to estimate things as conservatively as possible to avoid being as misleading as possible. So 8,000th collateral there for now. If we do size up, we'll size up, maybe go to MES, drop this down, but at the end of the day, it is what it is. But we've made $910 off of those so far. And if you take a look at what we've got set up for next week, we've got a 394, 401 strike strangle. High level, what does that mean? We hit max profit if XSP finishes Friday anywhere between 394 and 401. And further, we're going to make money, period, on our break-evens between 390.51 and 404.49. That, of course, is the low end, the put, minus the credit, and the high end, the call, plus the credit. That's the great part about these strangles. You've got this really nice max profit level, and let's actually pull the chart up to demonstrate what that looks like graphically. So let's pop it into a 5-day, because that's about the time frame we're looking at right here. Let's remove these old drawings. Come on. Bear with me as I click down through these to get a 1-day. There we go. So we know that our max profit range is going to be between 394 and 401. So if we draw 401 right here, that's 401 and then 394 on the low end. And you may say, HT, normally on these strangles, don't we kind of want these to be equidistant from where the stock is? And I would tell you absolutely on a given week. However, what we know about XSP, right? If we go to a 180-day basis, that RSI is at 70. The S&P 500 is starting to get a little bit overbought. On a 1 year, it's not as crazy. It's only down to 60.58. But consequently, on a 1 year basis, it really never gets above 70 very often either. Now, of course, if it does get above 70, we want to protect ourselves, and we have accomplished that because look, our break even, this is our max profit point, but the actual break even price itself is 404.49, which is way up here. So I believe we've got decent protection to the upside. And on the downside, this is max profit, and then our break even on the low side is going to be 390.51. And again, we want to think about this in the context of what we're holding in our overall portfolio. We want to be a little bit more bearish. So if this thing shoots down and we start losing money on the low side of this, yes, objectively, if XSP were the only thing that was in my portfolio, that would kind of suck. However, we know that our portfolio is almost overwhelmingly bearish. So if we get breached on the low side here, we are going to be making a lot of money off of the bearish trades that we have currently sitting in our portfolio. So it's one of those good problems, quote unquote, to have. And of course, if it does breach below these or breach above this, we'll manage this. We'll add one more and then hedge one more on the downside. But as of right now, as long as it's between these two red lines, right? Because these two red lines here are max profit. If XSP finishes anywhere between these two lines next week, we are going to take home a profit of $349. If XSP finishes anywhere between these, we are going to take home a profit, period. And on a 5-day basis, that's a decently wide range. So let's keep an eye on that. Remember some of our rules that we have set up for ourselves here to try to ensure maximum profitability. We want to take 75% or greater profit earlier in the week, right? And the great part about these strangles is, if this keeps running up and you're getting, pushed a little bit on the high side at 405, good news for you is this 394 strike put is probably going to be close to worthless if you're getting pushed on the high side. Because as one moves away and starts to lose you a little bit of cash, the other starts to make you some cash. And as it pushes further up, that's further going to increase RSI and further increase our bearish thesis for it to come back down for us. But that's XSP. That's how that works. And we are going to have that one set up for next week to hopefully take us back over $1,000 of cumulative profit on those types of trades. Peloton is the next one we've got on the list here. You'll notice we set this one up pretty similarly to Wayfair, where instead of just taking the naked call and playing it down in that regard and kind of playing it similarly to like a reverse wheel where we're going the other way directionally, I'm a little bit more worried about this one just completely running up and setting on fire. As we've seen over the past 5 days, this is going to be a very, very common chart for a lot of these stocks that we're playing back down just because the market ran up so much and took a lot of these stocks with it. Now we could, if we go to a 1 year basis, we'll see it's at 64.24, not quite overbought, but on a 180-day basis, it's running pretty hot, right? On Friday itself, I got up to 86, which is very, very high. So we're happy to play it back down from there. Let's remove these drawings really quickly as well. We'll first look, okay, RSI is super high. Where do we want to play it down from? We will zoom out to the 180-day chart and see, okay, we've got, maybe a peak here at like 13.5-ish. That looks like a decent point of resistance. If we look maybe, I don't know, here-ish, you've got a level where it bounced off of, and then broke down below back in June of last year. So that's potentially another level to play off of. So this 13.4 is a little bit far away, but the 12.32 that we see right here, I think is a much more realistic target. Had we looked at just the 12 and sold that for 33 cents, yeah, our break-even price would have been right around there. But when IV gets a little bit lower, and we'll talk about this a little bit later in the stream, looking at VIX, it's very, very low. But when IV gets a little bit lower, what does that do? It knocks down option prices. So I like to use some more spreads when volatility gets a little bit lower because you could buy that back leg to hedge the position out a lot more cheaply. So what we ended up doing was, sell the 12.13 for 21. And remember, the 12 on its own would have been like 32, 33-ish. So we're only sacrificing about $100-ish. And yeah, that is like a third of the return. However, The upside to this is the fact that if this thing runs to like 15 and we had sold that 12 strike call, we would have lost like $2,800. The most we could lose on this now is 790. So we save ourselves a decent bit of max potential profit. And we'll remember on these positions, we're going to win a lot. We win a lot, right? If you look at last week, we pretty much won every single position. The week before that, we only had one loser, and it was IQ. So we've had like two tickers maybe so far in this entire year that we've lost money on. We're going to win a lot. But when we do lose, because it will happen, no matter how many trades in a row you may win and may convince yourself that, oh, I'm incredible, I'm never going to lose again, it's going to happen. The biggest thing with this strategy is making sure that when we lose, our losses are limited. So taking the credit spread approach on something like a Wayfair, taking the spread approach on something like a Peloton, I think is a great way to limit those potential losses. So instead of being worried about it running up a ton and losing like $3,000 on one trade, which could wipe out our entire week, max loss is only 790. And again, that max loss, one, it has to breach 13, and two, you have to hold until Friday at expiry, so we conceivably can get out for a lot less, and that would blend in very nicely. I mean, it sticks out like a sore thumb, but I guess that loss could be mitigated, better said, very nicely by some of these other profitable positions that we would potentially have on there. But as it stands right now, love the bearish thesis on it because, again, we've got that high RSI. We've got an identifiable point that we could play it back down below. And we've got a little bit of a cushion, right? Our break-even's 12.21. Peloton closed on Friday at 11.63. So in plain English, this trade is going to make us money so long as Peloton doesn't run about 5% or more next week. And anytime you've got yourself in a position where, I think that in general, there are kind of five things a stock can do, right? It could go down a lot. It could go down a little. It could stay flat. It could go up a little. Those four outcomes right there, we're going to make money on this trade. The only outcome that we don't make money is if it goes up a lot. So we'll see what happens. But I like to think the odds are on our side, and our performance, love flipping back to this tab, historically is definitely indicative of us having the odds on our side. We've been outperforming that NASDAQ and S&P 500 very handsomely since July of 2020, and we're going to keep that up with the strategies that we're implementing here. American Airlines. We just talked so much about how we love the spreads. Excuse me. Let's talk about a couple more where we're going naked for the upcoming week. American Airlines, ticker AAL, has been running off the face of the planet. Now, longer term, this isn't anything insane. I mean, it had a massive COVID drop, but it's not like this thing has jumped from 12 to 17, and then within the last 3 years, it's been trading at 100 or 200, and it's going to run all the way back up there. Longer term, we would expect it to start to run into some resistance around these levels over here, right? So if we zoom in a little bit closer on like the 180 day, what do we see where the stock's currently trading? We could potentially start to see a little bit of resistance, 1788-ish. And what I will say is we did start this thing out with the 17 strike call for a 1737 break-even price. But again, we always want to have plan B. So a plan B for us is we can add more to get up to that 18-ish level, or presumably we could roll it up and out to the following week to then eventually get that break-even price up to the 18 level. But RSI is just absolutely through the roof on this one. We go to the 1 year. This is the highest 1 year RSI out of any stock that we've looked at so far on the stream tonight. 79.05 right here, which is just massive. And again, approaching a level where it's bounced around a little bit, but it's running super, super hot. And typically we like to look at these charts and say, oh, last time RSI got this high, it fell back down. RSI has not even been remotely this high. The last time it even flirted with 70 was back in April of 2022. And it went from 2142 to 1541 over that stretch. So that's why we love this technical indicator. I think it's running super, 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 super hot right now. On a 3 year basis, it's tough to find something this high. You'd have to go back to March of 2021. But yeah, in the short term, love the way these technical aspects are lining up on this one. And that's one where we're going to bag about $370 of profit should it fall back down below 17. Carnival Cruise Line, another good one that I think is a solid spot to play. Barca fan, if you're watching this one, that's who called that one out in our Discord, so I appreciate that. 1 year basis, we see a 71.82. It's overbought. And what happens around here? We're almost lining back up with this resistance, but where exactly, let's take this drawing off, where are these peaks? These peaks are at about 11.23 is where this line is falling. So we go to the 5-day, we zoom out. That's where those peaks are. So typically you may be a little bit more aggressive if you took a look at the 1-year chart and said, oh, RSI is at 71.82. I'm ready to just play this thing down from pretty much exactly where it is with the 10.5 strike call. However, this one's traded a little bit higher in the past. Could it run a little bit higher? Sure. So I think what I wanted to do is maybe be a little bit safer. And instead of 10.5, the current price, I went up to the 11 strike for 14 cents. And that's going to put our break-even price at 11.14 for the coming week. And this line right here, remember, is at 11.23. So pretty much on that line. We could have gotten about 20 more cents of premium. I don't hate the 10.5. I just like to be a little bit more conservative because this wasn't something that was in my initial plan. It was a little bit more of an add-on trade, so to speak. So I wanted to be a little bit safer with that. But again, starting with the break even up here because this lines up with the peaks, I think is a fantastic place to be on this one. Another trade that's going to make us money if either it or the market goes down. But even if the market does go up, it's one of these instances of a stock that has high RSI and is running into resistance. So similarly to something like TJX, PDD from last week where the market went up and those went down because they had those characteristics that we identified. Hopefully, regardless of what happens, those are going to be working the way we want. And because so many of these trades are bullish, right? The only thing, or bearish rather, the only thing up to this point that was bullish that we've talked about is the put side of a strangle. So far from an overwhelmingly bullish portfolio. So what we wanted to do on the back end to kind of cap out the portfolio is add a couple more bearish trades. We've got a Google 91 strike put. We've got a Ford 12.5 strike put. Why did we pick these? We could have done something like an Amazon where we did like formally the idea of Amazon, but look, RSI is running pretty hot. It's bounced from 81 to 98 in a short time frame. I think that's pretty significant. If we take a look at something like a Google, we've got a much more favorable RSI down at 54. The bounce from 87 to 92, so it's still kind of near those lows. And I think is a very, very well-valued stock. I believe they have a PE. I don't want to lie to you guys, but if we type in Google stock, their price to earnings ratio rather, is 18.65. So valuation is a super, super big concern to me when I'm going bullish in some of these trades. PE ratio is a very, very good way to identify that, right? I think the average PE ratio of the S&P 500 currently is in the low 20s. I don't know if it's below 20. I'd have to check. But anytime you've got like that high teens, that's probably a decent-ish valuation compared to something like Amazon, for example. If you look at Amazon stock, their PE is 90.55, which is crazy. But Amazon is a good example of a stock where they invest a lot of money in CapEx, so their actual earnings maybe aren't as representative of their business operations, so kind of an exception to the rule, so to speak. But with that said, pay attention to that PE ratio because when interest rates are rising, the Fed's trimming down the balance sheet, and things start falling, the money is going to move into the more value plays. Google, I think, is a better value play than an Amazon, than a Microsoft, you name it. So that's why I put some cash in there. And then finally, Ford is the last one that we took. If we go back to that tracker, we'll see that we took out the Ford 12.5 strike puts for 20 cents, and that'll bag us $200. We've got 200 plus 124 plus 210. We've got about $530 of profit here derived from bullish trades, which is like, okay. Being completely transparent, I do worry slightly about having such a bearish portfolio because from an outperformance perspective, right, we want to make our money when the market goes down and we outperform. But if the market really has another huge week, which it definitely could, right? The market could stay irrational a little bit longer than you could stay solvent. I think that's one of my favorite quotes in the market. If we run into a situation where things just keep flying up, we're probably going to lose money this week, but it would take, one, a pretty big jump, right? Because we've got some nice cushions on these. But that's kind of what we want to avoid. We're off to a decent start. It's down about 0.30%. But I think ideally on Tuesday, what we do, if we do see a little bit of a pullback, is look for maybe one or two more bullish trades to add. It's just right now, after such a big week 2 and a decently green week 1 in the market, there aren't a lot of great bullish entries. So again, don't want to get greedy and chase anything. We've got a lot of bearish trades. So I think the idea behind me wanting to add that bullish isn't so much behind greed, but rather it's based in me wanting to balance out the portfolio just a little bit more, right? Maybe get 600-700-ish of profit from the bullish and then keep that 2,000-ish of profit from the bearish trades. So that's what we've got set up, right? And then if we talk again in a week and the market is completely fallen apart, we are going to be, run a little bit of a victory lap because we nailed it, right? And we're going to be making some decent cash in a red market this week if that does come to fruition. One thing I do want to point out again, that really, really big drop in volatility. These big drops in volatility typically precede larger dips in the market. So when we take a look at SPY, right, we saw that RSI is getting a little bit high. It's running into this red line, which is the top end of this downtrend that it's been in lately. If you take a look at something like UVXY, which is measuring volatility, it's oversold. It's oversold. Volatility is oversold. And what happens when volatility gets oversold, right? We could maybe look at something like right here, mid-August. We've got the end of November, beginning of December. So let's keep those in our mind, right? Mid-August, end of November, beginning of December. We look at the S&P 500. We look at mid-August. What happened mid-August? On the 18th exactly, it went from 430 down to 389. That's a pretty significant slide the last time UVXY was oversold. Let's look at late November here. Let's look at late November. It's right here. On this big green candle is when UVXY got oversold. And we went from 409, dipped, came back up, but then came all the way back down to 380. So from peak to trough, 408 to 380, 430 to 390. All we're looking for here is just a slight decrease, right? We don't even need anything that outrageous. But the idea is if things do keep running up and volatility does keep running off, we'll scale further into those bearish trades. So hopefully we reap larger rewards if we do finally get the dip that we may think is on its way. But again, there's nothing conceptually stopping the market from running up through this. We don't want like a full bearish portfolio where we're leveraged insanely and then really begging on the downfall of the market, because that's never a fun thing to bet on. And there's nothing worse than being frustrated when the market is when the market's green. So again, we like having some of these bullish positions, but further, we're starting smaller on the bearish positions, and we're leaving ourselves cushions on the upside for those bearish positions as well. So that's what we've got lined up for the week. I think it's a great game plan. It's a short week. We've got a 4-day week, which always works, in theory, a little bit to our advantage as option sellers. So let's switch back to the full screen webcam. There's also some earnings coming up. We've got Netflix at the back end of the week, but I think nothing too crazy to look at. But earnings are always a decent place where you could find implied volatility in the market, especially in some of these situations where volatility is being sucked out of the market a little bit. Earnings are a great place to potentially find some of it and kind of largely get yourself into some positions that are a little bit disconnected to the market, disconnected from the market, that is, because they're going to be far more, the correlation is going to relate far more to the results of the earnings as opposed to what the market itself is doing. So that's definitely another good place to keep an eye on. You may not say, hey, I think the market's running way too hot, I'm going to go bearish. You might say, okay, the market's running way too hot. Maybe for now I'll focus on strangles and I'll focus on earnings trades. So I'm a little bit disconnected from that. But that's another way that you could potentially address an overbought market. But for those of you that have tuned in for another week, or those of you who are watching afterwards and made it to the end, thanks again for watching. As we like to say, this has been Hourglass Trader, where as time passes, we make money, and we have made money the first 2 weeks of the year so far. So it's been an awesome start to the year. We've got a little bit more of an unorthodox bearish approach, which you don't often see from us for week 3 of 2023, but we're hoping that based off the technical indicators that we've seen, based off of the way that we've played those bearish theses, that it's going to work out in the end for us. But until next time, we'll see you guys later. Thanks again, as always, for tuning in. Hourglass-trader.com to join our Discord server. It's the big purple button in the middle of the homepage. Can't miss it. Perfectly free to join and learn the strategies that we have. And we also have the HT Premium option available for those who want to take your trading to the next level. But again, we'll be talking intraday every single day in the Discord server if you want to join us until next week. But hopefully we'll see you guys once again, same time next week, with more money in our account than we currently have right now. So once again, cannot thank you guys enough who tuned in on your Monday night to watch us, and hopefully we will reap the benefits of that this coming week. Yeah, that's all I got. Talk to you guys later.